Hey guys, Justin here again from Simplified Investing. One video that I wanted to make was how to minimize risk when trading options. A lot of people hear the word options and they get scared of them, thinking they're way too volatile, they're difficult to understand, and something that you can't play. And I'm here to tell you that that's not true, and I will go through 6 steps on how you can trade options comfortably while minimizing your risk. So, starting things off, the first one that I recommend is playing light. And you may wonder, what do you mean by playing light? If you have, say, $1,000 account size, don't go all into one position with your account. What you can do is make 10 $100 plays, 5 $200 plays. What I'm trying to get at is don't play with a lot of your contract or a lot of your position into one contract. This greatly increases your odds of having a blown up account, simply because you aren't diversifying your positions and you are just playing one position. The next really big key that I have, if you are swing trading or playing a lot overnight, is you have to have a hedge. There is no way really around this. If you want to become consistent or grow your account through swing trading, you have to take into consideration both sides. You can't just go all in on calls and one day the market goes down a lot and then your position's down a lot and then you're stuck there with those contracts and ultimately your account has already been blown up. So what I recommend is, if you are playing contracts, then you have to, if you are playing contracts, then you have to have a hedge on either side if you're going to hold long term. And essentially what this does is it protects you on both sides. And even when you get these rapid volatile movements that we've seen in the market recently, a downturn, for example, in SPY, like today of 3%, will greatly cover your losses from calls, as those contracts are running more than 100%, which, as you know, the loss that you can face from a call will be 100%. So it outweighs the negatives if you are hedging, actually, and today is a perfect example. So the next thing that I think is going to be really important to minimizing your risk is going to be either buying in the money or buying time. As you guys know, out of the money contracts do move more, but they are more risky. If you do buy in the money, essentially that means the market anticipates that finishing in the money at expiration, it will move less. It won't move as much as an out of the money contract, simply because the contract price has already reached that, and it's ultimately going to likely stay in the money at expiration. So those don't move as much as, say, a out of the money contract. You can see very rapid movements on out of the money contracts, but if you're looking to minimize your risk, then buying in the money will greatly help that. As for trading with time, that's something too that if you really want to minimize your risk, you have to trade with time. There's people that trade the same week expiration, and that is really, really risky if you are swing trading that. You can day trade that with proper account management very easily, but swing trading the same week expiration is going to be difficult. So what I recommend doing, like for swing trading, for example, is if you get a month out, say the market's down 3% today, and you have a contract that expires this week, that call contract will be down, say, 80 to 90%, but if you have a month out and have time on that contract, it will likely only be down 20 to 30%, which is a lot better than if you're trading this week's expiration. So again, you can buy in the money or time to greatly help minimize your risk when you are trading options. The fourth step is going to be setting stop losses and taking profits. So as for setting stop losses, as you guys know, or if you're part of our team, you'd know, I don't specifically say, oh, I'm going to go in at 20% on this position, 20% stop loss, or 10% stop loss. And there's one reason why I don't do that. It's simply because you can get filled on those stop losses if the option does move quickly against you and get that filled. So like, say for example, SPY comes down here, hits that 271.76 support, has a quick push through but confirms that bottom. Sometimes that wick below that 271.76 support level could fill that contract for you, and then you get that reversal to the upside, but you close out because of a wick candle, the wick of the candle closing below this. So what I recommend doing, or what I personally do, and you guys don't have to do this, but I personally just watch the underlying movement. So say we break a support and I'm in calls and we confirm below that support, then I will go and close out that position. And same with if I'm in puts and say we break this resistance here at 274.08 and keep running. For example, if I was in puts and confirmation on a breakout here, then I would close out then. As for taking profits, this is something that a lot of people ask me about. One thing that I do that I feel like is very, very, very helpful in helping grow your account and preserving account management is going to be staggering your profits. So if you've seen our alerts, you can see that what I'll typically like to do is get 5 or 6 contracts, sometimes a little more, and what I do is close out half of these positions a lot of times, say at 10 to 15%, or it depends on the movement of the underlying, and then stagger sell those next 2 or 3 contracts, whatever it might be. And you may be wondering why I do this. I do this simply because if you take your profits, say on 4 out of 6 contracts, for example, and you leave 2 runners, at least you still have skin in the game for an upward movement in calls, for example, and you can still profit off that upward movement while still having those 2 contracts and already locking in profit on 4. And what that also does is that, say the stock drops and you're in calls and you have 4 contracts, then you'll still be up on the day from locking in those 4 contracts for profit before. While those 2 are dropping, you still have profit from locking in those 4 contracts, and you still have skin in the game for the potential of it going up and ultimately increasing your profit as well. The next one that I think also is going to be really, really helpful for you guys is going to be low IV plays and trade during slow times. So what do I mean by low IV plays? Typically, you're going to be looking for IV, implied volatility on contracts, to be less than 40%. Ultimately, this means that they are a cheaper contract relative to what they normally are. Whereas if you are playing a 100% IV contract or something along that nature, it will pose more risk, as you can have theta decay and you can have delta work against you, and ultimately an IV crush. That is also a potential with trading high IV plays. So that is also something to take into consideration. The next, trading during slow times, this is going to be something that will be less volatile, especially for options. It doesn't give you as much reward, but it also greatly reduces your risk. The volatility is going to be highest during the first hour of trading and the last hour of trading. So if this is something that you aren't comfortable with your risk management of your portfolio, then you can simply trade in between these times and not trade during the very volatile times. One thing that I recommend is to getting a feel for options trading during these times, and then once you build up your comfort level and your strategy, then you can trade during these rapid times. You will see faster movements and more rapid movements in your option price, but if you feel comfortable in your strategy and your plan, then you can trade during these more volatile times, as they pose a better chance or a larger chance for profit. And another thing that I think is going to be really helpful for you guys is going to be not playing earnings reports. These are essentially going to be gambling with options, as I know a lot of people reach out to me like, hey, I'm looking at this earnings report, or hey, I'm looking at Snapchat, for example, for an earnings report. And one thing that I recommend to people is that a lot of times these prices of options are already priced in on an earnings report, so you have to have a huge beat and a huge move in the stock price to see some of those option prices move. So say Snapchat has like 150% IV, the market's already anticipating that big move, so sometimes it'll take over like a 10 to 15% move to even see a call contract or a put contract in the green, which is why it is so hard. Not only do you have to have the stock beat by a big margin and shoot way up, you can also have the opportunity for it to go up, but not as much as you need to be in the green, or go down and burn all the theta and the premiums on that contract and ultimately ends up worthless. The thing with earnings reports is, yeah, you can have, say, a lead, or say like you were like, oh, I think Snapchat's going to increase users or whatever it might be. That's something that you can play off of into an earnings report, but ultimately the only people that know about how Snapchat's going to do are going to be the executives of the company. Essentially, playing earnings reports is going to be just like gambling. If you are playing light as a lotto, say you want to risk it, then you can go for it, but never go into an earnings report with all of your account. The last step here that I think is going to be helpful for you guys too is to let the plays come to you. Don't actively search for these plays and be like, I gotta trade. If you let these plays come to you, and say you set alerts, for example, and watch these plays all day, slowly developing those patterns in your mind and developing your strategy, you can just make these plays and let the plays come to you instead of chasing. And what chasing does for your risk is, say you see Tesla up 8% today and you have a fear of missing out, you're likely going to be entering those contracts in hopes that it will keep going up, which greatly increases your risk, as Tesla is already a runner and already poses great risk. So again, if you let those contracts or let those plays come to you, that will also greatly minimize your risk when trading options. I hope this video helps to have you guys understand some risk management tools that I personally use for my portfolio and what I recommend to helping you guys. And as always, if you could like and subscribe to our channel, it would be greatly appreciated. Thanks, and hope you guys all have an amazing day.